Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're taking a look at two S&P 500 stocks that have been beaten down so far in 2025 to consider buying now for at least 40% a long-term upside. And those two stocks are Thermo Fisher Scientific and Lululemon. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the two stocks consider buying for long-term upside that are beaten down so far in 2025, I just want to do a broader overview of the market, where we are at the moment, and why it might be time to kind of buy into the weakness of these two stocks we're talking about. So Wall Street turned its attention earlier this week. On Wednesday, I'm recording this Thursday afternoon, to rising U.S. Treasury yields after an auction for 20-year U.S. debt went poorly. So we saw the 30-year spike to its highest levels since October 2023. Before that, 30-year yields hadn't been at those levels since 2007. We also saw the 10-year spike touching 4.6%, slightly below still its January high or January levels and its levels from back in October 2023. This long-dated bond sell-off came as investors are growing a little bit more nervous about the possible negative impacts of Trump's proposed tax and spending bill that will have on the already growing U.S. budget deficit and debt pile. The market was due for a cool down already after the huge rally, and it could start giving up more of its gains if yields continue to climb on rising fears that investors are losing their appetite for U.S. debt. So if we see yields spike in the coming days, it would possibly increase the likelihood that the NASDAQ fades back and touches at least its 2024 July high, so those summer highs from last summer. If not, its 200-day or possibly its 50-day moving average, since it's up so big off those April lows and kind of just got to some overheat levels. That said, as I'm recording this on Thursday afternoon, the NASDAQ was up about 0.7%, trying to hold its levels at kind of the pre or post-Trump breakout from early November. So that post-Trump election level, that's a level that they're going to try to hold in the near term. If not, as I said, they're going to at least test the 2024 highs and then possibly that 200-week or 200-day moving average. The next pullback, though, likely won't last long as yields continue to come back down. And then as long as tariff negotiations continue, trade deals are made, and we have lower inflation and that strong earnings outlook remaining that sturdy foundation. So with that in mind, the overall 2025 tech earnings outlook has grown since the Q1 reporting season essentially over, besides NVIDIA. So since it went down significantly from mid-February to mid-April, but now we were calling for about 10.2% tech earnings growth in 2025. Now we're up back to 12.1%. So it's climbed over the last month, which is a good sign. And then overall, we're calling for 7.2% earnings growth in 2025 on 4.1% higher revenue. And then we're still calling for nearly 12% earnings growth in 2026 and then 14% in 2027. Obviously, those estimates could come down, but overall, the earnings picture has been really strong, especially considering all of the tariff worries. And no matter what happens, though, in the short run, as I said, the rebound over the last several weeks / kind of like month and a half at this point highlights two really straightforward kind of evergreen investing strategies, which is to buy into weakness and stay exposed to the market no matter what. So with that in mind, you kind of just think about that Warren Buffett mantra of being greedy when others are fearful and fearful when others are greedy, and thinking about buying stocks when they're, quote, on sale. Many people would kind of rush to buy maybe a TV or a car or fill in the blank when they go on sale by 10, 25, or 40%, but then might hesitate when stocks go on sale. But that makes not as much sense, especially when you consider that stocks are appreciating assets and most things that people are buying on sale are not. So with that backdrop, we're going to take a look at, as I said, two beaten down S&P 500 stocks that are still trading at least 40% or roughly 40% below their all-time highs, to consider buying now, as the market might start to look for areas that have not climbed all the way back off those April lows. So with that in mind, we're taking a look at the first of these two stocks, which is Thermo Fisher Scientific, which trades in the ticker TMO. It is still trading 40% below its 2021 highs, even though it soared 1,400% in the past 20 years to blow away the market. So now it might be time to put this beaten down stock on your radar, as it's holding a key trend line. So it's a diversified global leader in medical and lab equipment, specialty diagnostics, reagents, which are a substance or mixture that's used in chemical analysis, and other reactions, consumables, and much more. Its offerings serve the broader biotech and healthcare field, as well as pharmaceutical sector, operating under various units such as life science solutions, analytic instruments, and beyond. Overall, the company, as I said, kind of, if you want to look just at some various products, so laboratory supplies, laboratory equipment, laboratory instruments, clinical and diagnostics, chemicals, cell culture, protein and cell analysis, molecular biology, and various other just offerings that, as I said, it goes across the wide range of medical and lab equipment, pharmaceuticals, healthcare, biotech, all of this. It's kind of operating in the background of that whole entire world. Its business was booming long before COVID, but then it had a really big COVID boom. So it grew its revenue by 26% in 2020, 22% in 2021, and then 15% in 2022. So it was really hard to match that growth, and was never going to be able to do that. So it saw its revenue fall about 5% in 2023, and then it's kind of flatlined more recently. So its 2024 revenue came in roughly flat, up 0.1%. So it's kind of flatlined since that big COVID boom kept off an impressive decade-long run. So that's kind of the backdrop where we are now. Its GAAP earnings soared as well during that stretch, but have kind of faded back a little bit since then due to post-COVID normalization and some life science weaknesses in that area. Biotech funding is seeing a crunch as well. So its earnings estimates have faded over the last few years, and that's why the stock is still trading 40% below those highs, late 2021 highs. It reported its Q1 2025 results on April 23rd. It provided somewhat disappointing guidance, with its 2025 estimate down another 4%, with its 2026 estimate for earnings down about 3.5%. So nothing crazy. In terms of its most recent earnings outlook, it's not like it's falling off a cliff again, but it just kind of continues that downward trend. So some of that specifics for the week guidance they provided in Q1 were exposure to China, macroeconomic and policy headwinds. So this concerns tariffs. Obviously, some of this could not be as relevant in several weeks or so if there's more trade deals, but the company has heavy supply chains in China. China is a key source for a lot of its raw materials for its pharmaceutical and medical device products. So that's something definitely worth noting at the moment that might give investors pause. There's continuing to be a possible research funding crunch. The Trump administration has proposed reductions in academic research budgets, so that could hit the company as well. Overall, though, if we look, we're calling for about 2% revenue growth in 2025, and then getting backed up to about 6.5%, nearly 7% growth in 2026 to get up to about $46.6 billion, which would see it finally retake its 2022 highs. So that would be total highs, which would be a good sign. And then on the bottom line, we're calling for about 2% adjusted earnings growth in 2025, and then back up to 11% growth in 2026. So it's possible that now they've reached kind of the bottom of their current business cycle and are trending in the right direction if all goes well. It currently lands the Zacks rank number 3 hold. It is a $150 billion market cap Titan that's trading 40% below its highs and 40% below its average Zacks price target. Wall Street's still relatively high in the stock, so 18 of the 25 brokerage recommendations we have are coming in at strong buys, along with 3 buys and 4 holds, so no sell ratings in there at all. It's also still up 200% in the past 10 years versus its sector's 7% decline, and the S&P 500's 190% run. And as I mentioned up top, it's up 1,400% over the last 20 years. versus the S&P 500, which is up around 420%. So it's just blown it away. Yet it's only up about 17% in the past 5 years. It's currently trying to find some support at its early or mid, I should say midsummer 2020 breakout level. So that initial COVID boom, it's trying to hold those levels right here as we speak, while also trading at its most heavily oversold RSI levels on a 20-year time frame since 2008. So this could be, if you're looking at some technical levels, might be worth just dipping your toes into TMO stock here. And then on the valuation front, it's trading at 17.1 times forward 12-month earnings, which puts it right in roughly in line with its 10-year median, which is a positive sign there as well. So closing out here with Thermo Fisher, certainly worth putting the stock on your radar, trading 40% below its all-time highs, and it looks like to be at the bottom of its current business cycle. Obviously, some people might want to wait for a conclusion of what's going to happen between the U.S. and China on the trade war front, but that if you do get that quote all clear signal, it might be a little too late to buy Thermo Fisher down 40% from its all-time highs. And now we're going to transition to Lululemon, which trades in the ticker LULU. It's currently trading roughly 38%, so nearly 40% below its 2023 peaks. The company changed the fashion industry and possibly the way people are still dressing today, spurring an entire new way and fueling competition from kind of other copycat athleisure companies and then Nike and everybody else to get into that business. That said, many are worried that the fickle world of fashion, its days are numbered and its days of massive growth could certainly be behind it. So let's take a look at what's going on with Lululemon. So overall, the stock's up about 430% over the last 10 years, blowing away the consumer discretionary market, which is up about 20%. Lululemon is getting walled off by different types of competitors. So there's that rapidly growing luxury athleisure brand. So there's Alo and Viore. And then there's the companies like Target that also offer similar kind of lower cost versions of what Lululemon's doing. So then there's also kind of all the online only and the various things you might see on Instagram or places like that. So it's not an easy business to be in, and it's certainly facing some setbacks. Most recently, it said when it reported in late March that it expects its sales growth to slow this year, hurt by cautious consumers who are limiting their spending amid uncertain macroeconomic environment. As they're also losing a little bit of their sales among women, which is a key demographic. So that's kind of the backdrop of why the stock is down nearly 40%. That said, its net revenue still climbed 10% in 2024, with its international net revenue up 34%. So a lot of that growth is coming from outside of North America. Its comparable sales were up, though, just 4%, which is a big slowdown compared to what it had done recently. And in the Americas, its comparable sales were down 1%. So that's the big reason that everyone is concerned about Lulu, is the slowing growth in the key kind of US and North American market. That said, its gross profit was still up 12% last year. Its gross margin increased 90 basis points to 59%. And its operating income was up 17%. So overall, still like a really strong business. And now we're going to dive into maybe why it might be time to look at it at what could be some lows. So Lululemon, as I mentioned up top, has changed the way millions of people dress, encouraged all these copycats and big companies like Nike to kind of follow suit. We kind of know that story at this point. They're also operating a really high margin business. That said, though, the days of growth they were doing over the last several years are likely over at this point. They did 19% growth in 2023. They did 20 or nearly 30% growth in 2022. They did 42% growth in 2021. So that's kind of what they've been compared against. Yet they just did 10% growth in 2024, and now we're calling for about 6% growth in 2025 and 8% growth in 2026. So certainly a slowdown on the top line, which is the big concern. And then on the bottom line, we're calling for just 1.4% adjusted earnings growth this year and 10% growth next year. And in terms of comparable sales growth, so comps growth, we're calling for about 4% growth in 2025 to match what they did in 2024. But this was after a period where they did 13% growth before that, 25% growth before that, 32% growth before that. So the comparable sales growth and the revenue growth is certainly slowing down. That said, the company noted most recently on its Q1 earnings, its Q4, this was of 2024. They've yet to report their Q1 results, though they will in a few weeks. Its Power of 3 times 2 growth plan, which is calling for doubling of its business from 2021 net revenues to by 2026, those key pillars kind of remain in place. So they said, as we begin 2025, we remain focused on executing that Power of 3 times 2 growth plan and delivering that exciting pipeline. So that's going to be driven hopefully by doubling of its menswear business, doubling e-commerce, and quadrupling international revenue, which is going to be more important than ever, as we mentioned that the U.S. revenue and North American revenue is slowing down. And it's also worth noting that its operating margin in 2024 was at 28.9%, which is almost unmatched in the non-luxury apparel space. In terms of its earnings picture, its earnings revisions have stagnated recently to help it land a Zacks rank number 3 hold. And if we look for 2025, its estimates down around 3% since its last report, with 2026 down around 6%. So trending in the wrong direction, but stagnating a bit recently. Overall, though, the company has a really solid balance sheet, which is a strong thing to have, especially since then maybe it could kind of look to new growth areas or maybe an acquisition in the future. It has about nearly $2 billion in cash, which is more than all of its in equivalents, which is more than its current liabilities. It has 0 long-term debt. So strong balance sheet, as I said, that could maybe help it pursue an acquisition in the future. And certainly it's in no dire straits if business kind of stalls out a little bit more in the near term. So overall, if we look over the last 15 years, the stock's up 4,600%. This blows away its consumer discretionary sectors, roughly 180% run. It's up about 433%, as I said, in the last decade. Yet it's now roughly neck and neck with its its sector over the last 5 years, up just 15%. It's down 38% from its late 2023 highs. It's kind of chopped around over the last few years. It's now trying for the second time in the last year to hold ground at its pre-COVID sell-off levels. So that's kind of the level to watch if you're into trend lines and kind of technical analysis, is can it hold its ground at this pre-COVID sell-off level when it was on a big run? It did hold that level recently, and it's now back above its long-term 50-week moving average while trading at roughly neutral RSI levels. So it's kind of been in a holding pattern recently, and it could break out if they report positive results in the next few weeks. And then on the earnings front, it's trading at a 75% discount to its highs and 50% below its 10-year median at 21.6 times forward earnings, which is also a 50% discount to its sector, even though it's crushed that group of stocks for the long haul. So certainly worth putting Lululemon on your radar. You might want to wait for it to report its Q1 2025 earnings results on June 5th. That said, if it does have a stellar report or offer strong guidance, it might be a little late to buy it down 40% from its peaks, but overall, definitely worth putting both Thermo Fisher and Lululemon on your radars and possibly buying them now, trading around 40% below their all-time highs. Even though the market has stormed back, these two stocks have not done that. And remember, if you take kind of a long-term view of the market, it's always best to buy strong, best-in-class stocks when it's seemingly no one else does. So that does it for me in this episode of Full Court Finance. Until next time, I'm your host, Ben Rains.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.